The more sophisticated it is, the more fragile it is. That's just how everything is, right? Because everything relies on machines, and if you fool one spot in the system, you push the whole thing over. That's exactly what we're living in. We think that the financial system is so protected and so massive. Well, that's specifically what makes it.
You're watching Silver News Daily. Subscribe for more.
The alarm bells are ringing, and this time, they're coming from Rafi Farber, the man who's been tracking silver like a hawk for years. He's not mincing words. We are standing on the edge of a total collapse in the paper silver market. The London Bullion Market Association, one of the largest silver clearinghouses in the world, is now sitting at just 5,500 tons. That's the lowest in over a decade, and the implications are massive. When those vaults start to run dry, it's not just a supply issue, it's a confidence issue. And once confidence breaks in paper silver contracts, there's no telling how fast the house of cards will fall. Farber's warning is clear. This isn't just another dip or correction, it's a system-wide fracture. And it's not just the LBMA. Around the world, warehouses are seeing inventory drained, premiums are spiking, and physical silver is becoming harder and harder to get. Meanwhile, the mainstream media barely whispers about it. But behind closed doors, insiders know what's coming. When the paper promises can't be fulfilled, when the contracts are called in, and there's no metal to back them up, the price explosion won't just be dramatic. It'll be historic. So the question is, what does 5,500 tons really mean for the silver market? Why are the warning signs flashing red right now? Stay with me, because once you understand what's really happening behind those vault doors, you'll see why this might be the most important moment in silver's modern history.
Taken by the Daniel Oliver calculation of if you take the market price of gold and you multiply by the amount of gold that's supposedly represented by the Fed's gold certificates, how much of those, if you take the total dollar amount of that, what percentage of the Fed's other liabilities is it back? And the peak in 1980 was 130%, that was too much. That's why gold fell after that. That's functionally a gold standard, meaning if you take everything on the Fed's balance sheet, including all the debt that it has, and then you take the gold part of the balance sheet and you make it balance out the debt, meaning if the debt disappears, you still have that same value in dollars in the gold, or purchasing power in the gold, then that balances the balance sheet. That's what it's supposed to do. So I think we're still at like 7-8%. We're nowhere near the limit. I think the limit would be if we're going to have the 1980 numbers of 130%, which we had for one day. I don't expect that. That's not equilibrium. That's not going to be sustained. But 130% would be like $90,000 an ounce, which we could get if the Fed completely stops printing, and then a banking crisis ensues, right? And then we get to 130%. That could last for a day. We could hit 100% for maybe a month or two until a new derivative system crops up and then replaces the old debt with a new debt, some kind of haircut system or something like they did in Europe during the sovereign debt crisis. Something that could happen. But yeah, 3,060, it's nowhere near any kind of limit. What's causing it? This is always a fun game. You could always try to point to the proximal cause. Yeah, I think it's this, I think it's that. I think the mainstream media is saying that it's the tariff threats, and Trump is threatening tariffs on this, tariffs on that, and breaking down international trade. The proximate cause doesn't really matter. I'm sure there's a more correct answer and a less correct answer, but the beauty of understanding that gold and silver are money is that it doesn't matter. I mean, and then once you know that the end game is that gold and silver will balance out the rest of the Fed's liabilities, meaning all the purchasing power will go into the debt. As the debt loses value, gold and silver will gain value. Gold will gain value because it's on the balance sheet and because that is the money. Silver will gain value if the gold derivatives no longer work, because if the gold derivatives no longer work, there's no other way to divide silver, to divide gold, and that's why silver will go up. So it's nice that gold's going to 3060 because I want this whole thing to end as soon as possible, just so society can move on. But the sign that we're really close is going to be the gold to silver ratio, which hasn't really moved down. By down, I mean silver moving up. I think we're still at like 88, 90 or something. I haven't checked it in a while, but it's nowhere near any kind of endgame territory. But I do believe that when we start to move down to the 15-to-1 ratio or towards that area, it's going to be fast. In 1971, I think the total amount of time that silver was actually moving up in the 1979, 1980 era. And that was most of the move. I think it was a total of 4 months, right? Excluding the parts of 1979 where the gold to silver ratio was stable, which was like 2 or 3 months in that year. So so I think the whole thing was like 4 months. So we're going to see a move of about, from 90 to somewhere around 15 to 1. And when we start to see that move, it's going to be really fast. I don't know when it's going to start, but once it gets going, we're going to get there quick. There's not going to be time.
5,500 tons might sound like a lot, until you realize how fast that number can vanish in a world waking up to silver's true scarcity. The LBMA isn't just some arbitrary institution. It's the beating heart of global silver trade. It's where industrial giants, bullion banks, and sovereign entities settle their accounts. And when their vaults fall to levels this low, it sends a clear message. The system is running on fumes. To put it in perspective, global silver demand in 2024 surpassed 1.2 billion ounces. That's over 37,000 metric tons in a single year. So when the LBMA sits at 5,500, you're looking at barely 2 months of global demand if the entire stockpile were available for immediate delivery, which it isn't. And here's the catch. Not all of that 5,500 tons is actually accessible. Much of it is already spoken for, tied up in long-term contracts, held for ETFs, or sitting in eligible status, meaning it's not committed to delivery. When you strip that away, what's really left is a skeleton reserve, a fraction of what's needed to fulfill obligations if physical delivery is demanded. That's why this isn't just about inventory. This is about the integrity of the entire paper system. Historically, a healthy LBMA reserve acts like a pressure valve. It gives the illusion of calm even when market tensions rise. But now, with the vaults, this depleted and industrial consumption surging year after year, that illusion is cracking. As more investors wake up to the difference between paper silver and real silver, the question isn't how much is left. It's how much longer the market can pretend everything's fine. The LBMA's 5,500 ton figure isn't just a data point. It's the countdown.
I'm seeing the outflows from London to COMEX, or from wherever they're coming from to COMEX. It could be using London as an exchange. It could be physically from London. I think in the case of silver, it's physically from London to the COMEX, but it doesn't matter where it's coming from. The fact is that it's coming into New York, and I've been trying to find an answer as to why this is happening. I had on my channel Eric Young. I published a video yesterday, actually, and he's a COMEX expert. I talk about it sometimes, but that's not really my area of focus. My area of focus is like the plumbing of the central bank system and the depth, the deep dark depths of the monetary system led by the Fed. So what he said is that he thinks that there's an inflow into New York. Meaning the mechanical question is, we understand why there's an inflow into New York because for some reason gold and silver are more expensive in New York than they are in London or other places in the world. So what you would do is you would buy metal abroad and then ship it to New York and sell it there, and then you pocket the difference. There's always just money flows. It's like where do you get the most money from? And right now that's the trade. Now the question is why. So for some reason there's a premium being demanded for gold and silver in New York, and I don't know why. But Eric Young's opinion is that the U.S. government is buying gold. Now, I'm not sure if I agree that might be true, but and I guess the reasoning is that the government is buying gold, and gold bugs we want to say because they see the end of the fiat era, and therefore they want to buy gold to try to back whatever a new dollar would be, and then do a debt reset. Maybe I don't know. I don't think so. But I could be wrong. But you see, either way, we go back to the first point. It doesn't matter. If you own gold and silver, it's like it doesn't matter why this is happening. Because at the bottom line, the gold is the money. If you have that, you'll be fine, whatever the reason for it happening is. So if he's right, he could be right about the gold. Maybe the U.S. government is buying gold and trying to back the new dollar or restock Fort Knox or whatever we want to think. Then I spoke to another guy, I think his name was Mayor Valinsky, who actually believes there is no gold in Fort Knox. So if you want to take those two theories together and say that the Trump administration or whoever understands money in the Trump administration. I don't think many of them do, or any of them do.
If this all feels familiar, it should. We've seen this movie before, and the last time it played, the system came dangerously close to breaking. Back in mid-2020, in the wake of the COVID crash, silver inventories were depleted at lightning speed. Investors panicked, ETFs bled metal, and physical premiums soared. The COMEX had to respond fast, and they did, pulling in massive amounts of silver through ETF conversions like SLV, and even resorting to emergency imports just to keep the wheels turning. It worked, but just barely. That episode exposed the paper market's biggest vulnerability. When push comes to shove, it can't deliver. Fast forward to 2025, and we're right back in that same pressure cooker. But this time, the setup is even more dangerous. In 2020, the scramble was reactive. It came after a shock. Now in 2025, the restocking is anticipatory. The big players know what's at stake. They're not waiting for a run on the vaults to start plugging holes. They're preparing in advance, trying to shore up confidence before the dam breaks. That alone should be a red flag to anyone watching closely. The difference now is the mood. In 2020, there was still faith in the system. People assumed the crisis was temporary and that paper silver would hold. But that faith has eroded. After years of manipulation claims, delivery delays, and rising premiums, the market has changed. More investors want the real thing. They don't trust IOS anymore. And unlike 2020, this isn't about panic. It's about preparation. It's a slow, methodical shift from paper to physical, from trust to verification. And once that shift gains momentum, history tells us what happens next. Paper cracks, premiums spike, and silver goes vertical.
But I think they understand it better than the Biden administration, which doesn't understand anything. Could be right about the gold, but then why would the U.S. government be buying silver? It wouldn't be. Like, they'd have no use for that. So then you could say maybe, okay, so somebody caught on to the U.S. government buying gold, and then so there's a premium on silver too in New York. Okay, fine, but then we're kind of getting convoluted here, and as to what's really going on, nobody really knows. But what Eric also said, King Kong 9888 on Twitter, is that the float on physical gold at the LBMA in London is 0, which is why there's like a 90-day waiting period. I haven't tried to buy physical gold from London. I don't have the money to do that. So I can't tell you from firsthand that's what's happening, but I hear that's what's happening. And with silver, the float is something like 5,500 metric tons left, and every day now, if you check the NYMEX page at the CME website, there's like between 1 and 4 million ounces of silver flooding into New York from London every day. So if you take 5,500 metric tons, you divide it by 5, this is the average of 1 to 4 million, let's say like 2.5 million ounces a day. That's something between 5 and 7 months until the LBMA is out of silver. What happens then? I guess we're going to find out. Because the more monetary stress that we're under, the more silver is going to flow into New York, just because that's the double-edged sword of being the world's reserve currency, that the real money is going to flow towards the reserve currency. I guess you could analogize that to something like an immune system reaction. When the body is under attack, like the main organs get most of the blood. So I think the monetary system is under attack now, not by any, I'm not saying by any like nefarious conspiracy of people, though that might be true. I don't know. But I think just the nature of how it's been abused is causing this reaction. And I think it's going to continue until gold and silver run out from other places. And then we'll see.
The deeper you dig, the clearer it becomes. This crisis isn't just about supply, it's about trust. For decades, the silver market has functioned on a delicate balance between paper contracts and physical metal. The overwhelming majority of trades never settle in bullion. They roll over, cash out, or remain on paper. It's a confidence game. As long as no one calls in the metal, the illusion holds. But once that trust begins to unravel, the entire structure starts to wobble. And that's exactly what's happening right now. Investors are demanding physical delivery at a rate the system wasn't built to handle. And when too many people want real metal, not promises, the cracks appear fast. COMEX, for example, may have over 1 billion ounces on paper in open interest, but only a tiny fraction of that is registered and ready to go. If even a small percentage of contract holders insist on taking delivery, it pushes the system into a corner. That's why restocking is happening now. It's not about today's deliveries, it's about surviving the next test. But it's more than just logistics. It's psychological. Once people realize the shelves are thinning and the promises can't all be fulfilled, behavior shifts rapidly. The preference for physical silver becomes contagious. Trust in settlement mechanisms erodes, confidence in paper evaporates. And without that trust, the entire pricing mechanism, based on the assumption that silver can always be bought or sold on paper, ceases to reflect reality. This isn't about the number of ounces anymore. It's about a tipping point. When too many people lose faith in paper silver, the market is forced to reprice itself around physical scarcity. And in that moment, everything changes. Contracts become meaningless, prices become irrelevant, and silver stops trading like a commodity and starts behaving like a lifeboat.
Yeah, I just noticed this today. So one of the tricks that I do in my research, I have no problem sharing this. There's one author on Bloomberg. Her name is Alex Harris. I think her full name is Alexandra. I'm pretty sure she's a woman. And she's like the plumbing correspondent. That's what I call her. So I check her author page every so often. It updates. So I see now that she's quoting a paper. I forgot what it was called but it's by a guy named Anil Kashyap. I think it's an Indian name, so I thought that was a pretty appropriate name for a money printing guy. Like Neil Kashkari, they all have like the name Cash in the name, but you can say the name anything is Cash Patel. I don't know, maybe it's a popular Indian thing. So this guy is saying that the basis trade has to be bailed out. The basis trade is the trade where basically hedge funds, right? They sell futures in treasuries that are at a slight premium to actual treasuries, actual bonds that you hold the paper of those bonds, and so they sell the futures, they buy the treasuries, and then they profit off the spread, and they deliver the treasuries into the future. And they get like a few cents for each trade that they make, and then they multiply. How do they multiply it? By borrowing reserves, by borrowing the extra bank reserves, doing this over and over and over again. So the whole thing is worth about $1 trillion notionally. Now in 2019, when it crashed last time, which we called the Repocalypse in September 2019, it was worth $500 billion. And in response to that crash in the basis trade in September 2019, the Fed started expanding its balance sheet and then amped it up hugely to about $1.6 trillion by April, May 2020. And so now
there's a quiet storm brewing in the silver community, and it's picking up momentum fast. Across Reddit, X, Telegram, and even YouTube, there's a growing call for action. A coordinated push to buy physical silver on March 31st. It's being framed as the second silver short squeeze, a grassroots movement echoing the frenzy we saw in early 2021 when the Wall Street silver crowd sent ripples through the market and left major bullion dealers scrambling to meet demand. This time around, the energy feels more restrained, but the intention is crystal clear. It's not about going viral, it's about sending a message. These calls aren't coming from any one group or leader. Instead, it's a decentralized wave of silver stackers and hard money advocates pushing back against what they see as years of price suppression by bullion banks and a rigged paper market. Their mission? Drain the physical supply. If enough people demand real metal instead of paper promises, they believe it could finally force the market to reprice silver based on true scarcity, not manipulated futures. But while the enthusiasm is palpable in the corners of the internet, the retail response has been muted compared to 2021. Back then, silver products vanished from shelves overnight, and premiums exploded. This time, it's different. The core community is active, but the viral spark hasn't caught fire, at least not yet. Still, the intent behind the movement speaks volumes. Even if it doesn't trigger immediate chaos, it reveals the rising frustration and distrust simmering beneath the surface of the silver market. And here's where it gets interesting. These kinds of grassroots movements are no longer being laughed off by institutional players. After 2021, the bullion banks know how quickly sentiment can shift and how rapidly a niche online campaign can disrupt a fragile system. Whether or not March 31st delivers fireworks, it underscores a bigger reality. Confidence in the paper game is cracking, and more people are starting to act like it.
Well, okay. I don't have a perfect answer to this question, but I have like the start of what could be the logic. This is something I can't really have evidence for, but I can try to, from a positivist way, try to figure out why it should logically be true. And then the question is, do you want to trust me, or how biased am I, or what am I making up here in the steps? I don't know. But if I'm a foreign central bank and my assets are mainly dollars, right? Then and my currency is weakening, then I would, or let's say, if you're a foreign central bank and you're relying on the dollar system, then let's say you're in a currency crisis, and then in a banking crisis, then what you're going to do is you're going to try to weaken your currency to keep your banking system alive. So you'll buy more of your reserve, you'll buy more dollars. I remember the Bank of Israel doing that here when the shekel was strengthening. They bought more dollars. I think it was because of the war, other things like that. So when you are the reserve currency and your currency is strengthening, right? To weaken it, what else can you do but buy your reserve? If you're the reserve currency, you can't have other currencies in reserve. I mean, you can technically, but they're not gonna. That's folding back in itself. Like you have to go down a layer. So your reserve is going to be gold. So you could say that the central bank or its proxies or something or some other bank that it's controlling is buying gold in order to preserve its own banking system, because there's nowhere else to go in the pyramid. So that would be if the reserve currency is under attack, meaning its banking system is under attack, meaning the currency strengthens because there's a dollar shortage or some kind of financial crisis brewing that we don't quite see yet out in the open, but it's happening. Again, like remember, like before the 2008 crisis, gold was going up and up and up and up for like 6 years, right? It wasn't stopping. And before the 2020 crisis, it was also going up, and then it spiked at the end of the crisis. So we're seeing that now. So this means like this is the early innings of a financial crisis. When there's a financial crisis, the dollar goes up in value as huge demand in a liquidity crisis, liquidity crunch. And so the mechanical response is to acquire more of the reserve asset with the dollars by creating more dollars to buy that reserve asset. I would say directly, I'm not saying the Fed's printing money to buy gold, but I'm saying this is, it happens in more of an organic way that I can't really explain, but it's happening now because you're seeing the flows. I mean, we're not making these things up. So that's what I think is happening. I think we're at a strengthening banking crisis or financial crisis or some kind of crisis that involves the dollar strengthening, and that's why gold is flowing in.
While retail investors rally online, another silent shift is unfolding, one that could tip the balance even further. As gold prices surge to all-time highs across Shanghai, London, and New York, silver is being quietly pulled in its wake. But unlike gold, which central banks hoard and rarely move, silver's industrial use makes it a fluid, fast-moving metal. And right now, that fluidity is creating serious bottlenecks. Bullion is being sucked into U.S. warehouses at a pace that's tightening supply overseas, especially in London, where availability is drying up. The numbers don't lie. Lease rates for physical silver have been spiking, an unmistakable sign of stress. 1-month loans have been hovering around 5.23% per annum, having hit squeeze-like highs over 6.5% earlier in the year. That's not normal. Elevated lease rates mean one thing: it's becoming expensive and difficult to borrow silver. And that only happens when immediate supply is tight and demand is surging. The market is shouting that something's wrong, and it's doing it through the cost of time. We're also seeing a clear arbitrage opportunity form between U.S. futures and global spot prices. Silver on the COMEX is trading higher than London spot, sometimes by nearly $1 an ounce. That price gap is more than just a trading anomaly. It's an incentive. It encourages traders and bullion banks to ship physical silver across the Atlantic to profit from the difference. And when that happens, it doesn't just drain one region's inventory, it redistributes global tightness and exposes how little margin there really is in the system. This gold-silver dynamic matters. As gold continues to make headlines and draw institutional capital, silver is being treated like an afterthought. But in reality, it's moving faster, tighter, and with greater pressure under the surface. And that disconnect between perception and reality could be the fault line that snaps first. Because when investors finally realize that silver's fundamentals are more explosive than gold's, the repricing could happen in a flash.
What is it going to start to look like? It's going to start to look like 2008, except if you remember 2008, and I was still a young kid back then, I'm sure you were too. My financial consciousness was only just starting there, and that's kind of why I came into this whole arena, because I wanted to figure out what was going on. But I do recall that in 2008, the financial, call them bigwigs, fat cats, whatever, whoever's in charge of the financial system, the guys you see on CNBC, the people on the Fed, the people, the big bank CEOs, they all seem to be panicking, like blood draining from their faces and like really showing some kind of nausea on the air. But they were clawing for bailouts because they knew that would save them, and it did for a time. I think this time it's going to be like 2008, except bailouts are just going to make things worse. When we see another huge crash like 2008 in the guts of the financial system, and the Fed says, "Oh, don't worry, we're going to print $10 trillion." This time, the people at the top are not going to breathe a sigh of relief. They're going to panic even more, and then gold and silver are going to go up and up and up and up, and then they're going to realize that there's nothing that they can do except buy gold and silver and save themselves, because even if the big huge conglomerates, the huge banking system buddies, the huge corporations, even if they buy gold and silver, they're not going to save their huge international, multinational corporate structure entity thing, because that relies on everybody else having money too, right? They can save themselves maybe and move to an island or something, or save some pieces of capital, but it's not, no matter how much gold and silver they stack, they're not going to be able to save their business model, because everyone is going to be going.
Rafi Farber's alarm is no overreaction. It's a final flare before the storm. The numbers, the movements, the psychological cracks, they're all converging into a single truth. The paper silver market is reaching its breaking point, with the LBMA's reserves down to just 5,500 tons, COMEX vaults being restocked in a panic, lease rates spiking, and physical flows reshaping global inventories. The illusion of infinite supply is collapsing in real time. This isn't just volatility, it's structural. And it's not just analysts and insiders paying attention anymore. Across social media platforms, silver stackers are mobilizing, demanding delivery, and calling out the disconnect between price and reality. These grassroots movements might not break the system alone, but they're highlighting just how fragile it already is. Every ounce pulled from a vault, every premium paid, every refusal to roll over a contract, it all chips away at a market built on confidence. And when that confidence finally snaps, silver won't trade like a sleepy commodity anymore. It'll trade like a lifeboat in a storm. If you've been watching the signs and wondering when silver's moment would come, this might be it. But remember, this isn't financial advice. Always speak to a professional before making any investment decisions.
Now he says that the entire basis trade is about $1 trillion. Now, and here's the nuance that, okay, so you could say, oh, $1 trillion, okay. There are other markets that are bigger than $1 trillion. You could say, let's say the commercial real estate market has a notional value of a lot more than $1 trillion, or residential real estate, mortgage-backed securities have a notional value of a lot more than $1 trillion. So what's the big deal about $1 trillion? And I sort of mean that facetiously, but I sort of don't. So the difference is with the basis trade, it's not necessarily the size of it, right? If we're talking about an inverted pyramid, right, the stuff at the bottom of the pyramid is going to have a notionally smaller number, but it's going to support everything else. So the basis trade, it's not exactly using dollars. It's using dollars, yeah, but the dollar is called reserves, which another name for reserves is high-powered money. This is the stuff that gets lent out. And this is the stuff that's fractionally loaned over and over and over again. Thing is, they can't do it now because all this stuff is dead debt from 2008 that they keep rolling over into more reserves because it could never have been loaned out because the structure of the economy can't handle all that cash. So now it's just used for basis trades. So then the question is, why is a $1 trillion market, which seems notionally small compared to other humongous markets that are built on top of it, why is this such a critical one? Because it's at the base. It's right above cash dollars. You have gold, you have cash dollars, and you have the repo market. And then from there that's the high power money that supports everything on top of it. So if this $1 trillion goes, everything on top of it falls, which is why everything was falling during the repocalypse, which is why everything's going to fall now, which is why you have trial balloons from Bloomberg and this guy called Cash App who's saying we need to bail this thing out. And if they bail it out, last time was 1.6 trillion to bail out a $500 billion market. So I guess multiply it by 2, you got 3.2 trillion, whatever that leads to. It's going to be a lot of money, and they're going to have to bail it out. And it's going to be fun for some people when it happens, and it's going to be miserable for others.
Rafi Farber's alarm is no overreaction. It's a final flare before the storm. The numbers, the movements, the psychological cracks, they're all converging into a single truth. The paper silver market is reaching its breaking point, with the LBMA's reserves down to just 5,500 tons, COMEX vaults being restocked in a panic, lease rates spiking, and physical flows reshaping global inventories. The illusion of infinite supply is collapsing in real time. This isn't just volatility. It's structural. And it's not just analysts and insiders paying attention anymore. Across social media platforms, silver stackers are mobilizing, demanding delivery, and calling out the disconnect between price and reality. These grassroots movements might not break the system alone, but they're highlighting just how fragile it already is. Every ounce pulled from a vault, every premium paid, every refusal to roll over a contract, it all chips away at a market built on confidence. And when that confidence finally snaps, silver won't trade like a sleepy commodity anymore. It'll trade like a lifeboat in a storm. If you've been watching the signs and wondering when silver's moment would come, this might be it. But remember, this isn't financial advice. Always speak to a professional before making any investment decisions.
Yeah, the printing in the mainstream financial media, I don't even know if we want to call it mainstream. I think we're the mainstream now. Channels like yours and mine, like we're really the mainstream. Nobody really pays attention to the doctorate media anymore, other than just to see what they're saying. But nobody takes them seriously. They're all a bunch of clowns. They try to make it sound sophisticated, like, oh, if the Fed prints here, they use different words and they use different academic jargon for it. Really, what they're talking about is printing dollars at different layers of the pyramid. You print here, they call it one thing. You print at level 3, they call it another thing. You print at level 4, they call it a different thing. And then they have all these different acronyms for it. It's all just injecting different liquidity things at different layers of the pyramid to try to like even out a humongous pile of garbage that doesn't fall over and, wreck everybody. But that's what's going to happen. Yeah, I mean, look, that's how it is with everything, not just the financial system. When a system clearly isn't working, and I saw this myself in real life, not just in a theoretical financial system with digital data there that's changing, but I live in Israel, and in October 6th, 2023, we had this illusion that we had this army that was protecting us from invasion, and a huge border of all this technology with sensors and who even knows, like it was dramatized as the most technological defense border in the world. And look, a few thousand people came and rampaged and murdered thousands of people, with almost no response in like 12 hours. So, a tiny little thing can push over a seemingly sophisticated. The more sophisticated it is, the more fragile it is. That's just how everything is, right? Because everything relies on machines, and if you fool one spot in the system, you push the whole thing over. That's exactly what we're living in. We think that the financial system is so protected and so massive. Well, that's specifically what makes it so weak.